This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hey everyone, welcome back to the channel. A lot of you may be wondering why I don't hold split share funds. After all, the distributions are massive, and a lot of these funds have absolutely crushed the broader market. But I don't hold them. And that's not me saying they're a bad product or that people who own them are making a mistake. In fact, in a bull market, the capital shares of a split share fund can actually be incredible performers, and that's precisely because of the leverage built into the structure. In this video, I want to talk about what split share funds actually are and why I've chosen to keep them out of my account. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US. It allows you to convert your distributions much more efficiently. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Moomoo is excellent. Having that data organized like a digital pay stub is a massive time saver. If you're looking for a more efficient way to manage your income portfolio, Moomoo is definitely a choice worth looking into. The structure is actually pretty straightforward. Think of it like a co-ownership deal, a fund version of buying a property with a partner. The fund manager pools capital and buys a basket of blue-chip stocks, typically large Canadian banks, telecoms, and energy companies, the kind of names that are relatively stable and pay solid dividends. Then the fund splits itself into two different types of shares, sold to two very different types of investors. The first is called preferred shares. Buyers of these want stability, a relatively fixed monthly distribution, and priority claim on capital if the fund ever winds down. The experience is a lot like holding a corporate bond or a GIC. Predictable income, lower risk. The second is called capital shares, also known as Class A shares. These investors are the ones taking on the risk and going after the upside. Here's the key insight I think most people miss when they first look at these products. The capital shareholders are essentially borrowing the preferred shareholders' money to invest. Think about it this way. The preferred share investors put in their capital in exchange for a steady return. They don't care how much the fund makes, they just want their fixed monthly distribution. That capital gets pooled together with the capital share investors' money and deployed into the underlying stocks. From the capital shareholders' perspective, the arrangement looks like this. I put in some of my own money, I borrow the rest from the preferred share side, we invest it together, and every month I pay the preferred shareholders a distribution that works like interest. Whatever's left, all the upside and downside is mine. What makes this clever is that it works a lot like opening a margin account and using borrowed money to invest, but without the margin call risk. With a regular margin account, if your holdings drop too far, your broker can demand more collateral or force sell your positions. With split share capital shares, the loan is baked into the structure. There's no broker on the other end watching your NAV and pulling the trigger. Let's put some numbers to it. Say the fund launches with a total NAV of $20 per unit, $10 in preferred shares, $10 in capital shares. The capital shareholder put in $10, but they're exposed to the full $20 worth of underlying assets. That's 2x leverage right out of the gate. And that leverage is exactly what drives those eye-catching distribution numbers. The income comes from three places: dividends from the underlying stocks, premiums from selling covered call options on those stocks, and in some cases, a portion classified as return of capital, which reflects leveraged capital gains being distributed. If you already hold 1.25x leveraged covered call ETFs, this distribution structure should look familiar. ROC shows up in those products too, and most of the time it's just a tax classification, not necessarily a sign that your principal is eroding. So I won't go deeper on that. At this point, you might be thinking, this just sounds like a pretty standard leverage structure. Lots of products work this way. And you'd be right, up until the part I'm about to explain. This is the part one really want to focus on today. The leverage in a split share capital share isn't fixed. It floats passively with the fund's NAV. Unlike a leveraged ETF, there's no daily reset mechanism bringing it back to a target multiple. Here's how the math plays out. Fund launches at $20 NAV, $10 preferred, $10 capital leverage at 2x. The underlying drops 20%. Total NAV falls to $16. Preferred shares stay fixed at $10. Capital shares are now worth $6. Leverage has drifted up to 2.67x. Keep falling and it keeps climbing. But here's the other side, and this part often gets left out. If the underlying rises 20%, total NAV goes to $24. Capital shares are now worth $14. Leverage drops back down to 1.7x. This mechanism is neutral, cuts both ways. Yes, leverage amplifies the decline on the way down. But on the way up, especially after a big drawdown when leverage has been passively pushed higher, the rebound in capital shares can be significantly more powerful than the underlying itself. For investors who can hold through the drawdown without being forced out, that dynamic is actually a structural advantage. Compare that to a 1.25x leveraged covered call ETF, where the leverage is actively reset to stay near the target. Underlying drops 20%, you're down roughly 25%. Predictable, linear, estimable. So the question isn't which product is better. The real question is, can you actually hold through the drawdown? For a pure cash account investor, that's painful but survivable. Deep drawdown, violent rebound, if you can hold, you hold. My situation is different. My account structure makes the can you hold question a lot harder to answer. My strategy works on two levels. First, using the S&P 500 as an anchor and deploying margin capacity progressively as the market pulls back. When prices fall, I buy more. The deeper the drawdown, the more I'm adding. I'm waiting for the rebound. Second, using distributions to service margin interest. Every month, the distributions from my holdings cover my borrowing costs. The leverage is slowly and automatically being paid down. I don't need to reach into my pocket. Together, these two levels create a self-balancing system. Maintain margin capacity for me to buy the dips, while distributions are quietly reducing leverage in the background, and wait for the next opportunity. The whole thing depends on one assumption: that my portfolio's NAV decline is relatively linear and predictable, and that my margin capacity is actually there when I need it. That's exactly where split share funds break the system. The available margin is tied directly to your portfolio value. Holdings go up, capacity expands. Holdings drop, capacity shrinks. And if it drops far enough, your broker triggers a margin call and force-sells your positions. Now imagine I'm holding split share capital shares when a broad market sell-off hits. That's precisely the moment I want to be deploying margin to buy the dip. But the dynamic leverage in those capital shares means my NAV is falling far harder than the S&P 500 itself. The index drops 20%. My split share position might already be down 40% or more. So the more the market falls, the more opportunity one sees to buy, the faster my margin capacity is collapsing. And in the worst case, it's not that I have no capacity to add. It's that my broker triggers a margin call and force sells what I already own. Instead of buying at the low, I'm being sold out at the low. By the time the rebound comes, I'm already out. With a 1.25x covered call ETF, the same market drop produces a NAV decline that's proportional and estimable. S&P falls 20%, I'm down roughly 25%. Margin compression is gradual and I can plan around it. I don't suddenly lose my ammunition right when I need it most. That's the real reason I don't hold split share funds. Not because they're a bad product, but because their NAV cliff drop behavior directly conflicts with my strategy. The worse the market gets, the harder they fall, and the faster they drain the very margin capacity I need to execute my plan. To be honest, when I restructured my portfolio around income-oriented funds, I already had this margin strategy mapped out in my head. For me, it's very much an experiment. I'm testing whether this approach actually works in practice. So this video is really just me sharing why I personally don't hold split share funds and exchanging some thoughts on how these products work. It's not financial advice. If you found this useful, a like and a subscribe would mean a lot. And I'll see you in the next one.